Hello, CS family. Welcome back to my channel, Chantel Stuff. It's your girl, Chantel here, your hostess with the mostest, back with another video. If you're new to my channel, go ahead and hit that subscribe button. Make sure to give this video a thumbs up. Also, hit the notification bell so you're notified every time I drop a video. Hop into the comments, let a sister know what's on your mind, and share this video with anyone and everyone. Hopefully everybody is having a phenomenal day on today. Wanted to hop on and give you a short video about what is an interest rate. I had someone mention to me, why not do a video on what is an interest rate? Some of us just don't know. So here I am with that video. What is an interest rate? Your interest rate is how your loan is priced, right? So how you're priced for that loan, what you will pay that financial institution back for them letting you borrow that money, right? So a lot of times you might hear a daily per diem. That's your daily interest rate. So it's a percentage of the loan balance that you pay monthly, right? So it occurs daily. So you'll be able to see how much that interest rate is going to be daily for how many days in that month, and that's how much is going to be added to that principal payment, and that's what you're going to be paying in interest. That's what you pay back. That's how an interest rate is used. It's how you're priced for that loan. That's how they know what you pay back. On your loan agreement, when you look at your total finance charge, your total finance charge is your interest rate in dollars. So if you take that loan to term, so if you have a term that's 60 months and you pay that loan for that full 60 months, that is the total amount that you'll pay back in dollars, that finance charge, to that financial institution. That number is figured by whatever percentage interest rate you have against that loan amount, right? So that's how much you're going to be paying them back. It's very, very important to always look at that number. A lot of times people may think, well, my interest rate, yeah, they told me it's like 8.5, but that doesn't sound like a real high number. Well, it all depends on how much that you're going to borrow and how much you're going to be paying back, right? So once you look at that total finance charge, it may be something that you don't want to pay back. Sometimes, it gets high, $5, $10, $15, $1,000 that you're paying back on top of what you borrowed to the financial institution. That's what's worked into your payment, right? So if you do the math, you'll see that it's worked into that payment, and that's what you're going to be paying back, right? So a lot of times you may change your mind on accepting a certain interest rate or going so high in a loan when you see how much you have to pay back. So when you're looking at your loan agreement or your note, look at that total finance charge. That is your interest rate in dollars. Now, there is a way that you can, avoid paying all of that interest, and your interest rate could be almost obsolete, right? Because you can turn most loans into whatever you want. If there is no prepayment penalty, meaning you don't get, a certain fee that you have to pay if you pay that loan off early, or you don't have to pay all of that interest regardless if you pay it off early, So some financial institutions do not have prepayment penalties on their loans. What that means is you can kind of turn it into what you want by paying extra. You can pay principal only payments. You can pay your regular monthly payment, and any additional money that you want, you can apply to the principal only, and you never pay interest on any of that money applied to principal only, right? And if there's no prepayment penalty, you're not going to be penalized if you pay it off early. So if you're very, aggressive and you stay consistent with attacking that principal, well, then you can save yourself a lot of money, and that interest rate really doesn't matter, right? So if you go into a loan that is a 60-month term, 5 years, and you attack that principal and you pay it off in like 24 months, 2 years, or 36 months, 3 years, well, you just saved yourself 2 years off that loan and 2 years worth of interest, and you really turned that interest rate into whatever you wanted it to be according to how much you pay. So you will not be paying that 8.5%, back, in total. So it all depends. So that's, what an interest rate is. That's how it's used. That's how, your loans are priced. And the way that, most financial institutions determine what your interest rate is, they're going to be looking at that credit score, right? So your credit score is going to determine usually where your base rate is, and if it depends on what type of loan it is, if anything else is going to be added, or even if it could be, reduced a vehicle loan, right? So the year of that vehicle may determine if there's going to be points added to that base rate, your loan to value, how much that you're going to borrow from that financial institution against how much the value of that vehicle is. Sometimes if you don't borrow as much and you put down, a nice down payment, sometimes you can save on the interest rate that way. You can get it reduced by a point, 3/4 of a point, a quarter of a point, half a point, whatever, half a percentage point. So you can save money and do different things like that at different financial institutions. So with your unsecured loans and all of that, typically there's tiers at most financial institutions, and your credit score will determine which tier that you're in. So that's pretty much how financial institutions determine what interest rate that you're going to get. They're going to look at that credit score. If you're let's just say if you're in the low 600s and below, you're going to be looking at higher interest rates than most. If you're going to be in the high sixes, which is not like an outstanding score, not going to, give you any smoke screens here, just going to be real transparent and honest. It's not the best out there, but you're going to start getting lower rates, in the high sixes, 700s and mid to high 700s and 800 scores. So of course, anything usually 750 and above, you're getting like the lowest score, the lowest interest rates out there, right? So if your score again is like the low 600s and 500s and 400s, if you can still get financed, depending on where you go, what's going on, you're going to be looking at higher interest rates, right? So that's how financial institutions determine which rate you have, and that's what an interest rate is. It's a percentage that is used to price your loan, and that's how much you're going to pay back to that financial institution, and that's how you know what it is. Now, if you have any questions, make sure that you're asking that financial institution all the questions that you need to get your questions answered, to make sure that you don't walk away from that closing table without understanding how much you're paying for that loan. That's how you price for the loan. Your interest rate is how you are priced for that loan, what you will pay that financial institution back for what you're borrowing. So that is an interest rate in a nutshell. Hopefully this video helped somebody out. Hopefully this video made somebody feel better and lifted somebody up. You all have a phenomenal day, and I will see you all in the next video. Deuces.